Testing 1, 2, Doctor Business here. I'm here to save the day. I'm so sick of y'all being lied to. God damn it, I'm so sick. Shit. So, let's talk about this, man. How y'all doing out there in YouTube land? Doctor Business here. And honestly, I'm so sick of y'all being lied to. I'm so goddamn sick. I'm gonna start making these videos on a consistent basis, and basically I'm gonna cover some topics as it pertains to business. If you don't know me, and if it's your first time joining me today, my name is Brian Otieno, founder of Pentic Consulting Group, and I help entrepreneurs just like you navigate and solve the complexity of starting their dream business so they can live the life of their dream and get off the endless, self-defeating, pointless rat race that they're currently in. On today's topic, I want to talk about a very common topic, but there's just so much misinformation that I've seen on YouTube, and I kind of want to just clarify things. I mean, I'm sick of y'all being lied to. Just to be straight up, I'm sick of y'all being lied to. There's this famous quote, and I have this actually in my book. If you haven't checked out my book, we're going to talk about this later on, 3 Paths to Living, but there's this famous quote by Darryl Brown. Mr. Darryl Brown said, "If you want to impress people, make things complicated. But if you want to help people, keep it simple." That's going to be pretty much my main mission as I go over this channel. Is I'm going to try to pretty much simplify a lot of these topics as it pertains to credit, funding, entrepreneurship, starting your own business. There's a lot of clickbait videos out there and just a lot of misinformation. But we're not going to talk too much time about them. Let's talk about what's going on. And this first video topic that we're going to talk about today is the 5 factors that affect your credit score. And I'm going to have a chart somewhere here or there. Somebody, one of my editors is going to put a chart out there. It's also on my book. But we're going to cover the 5 things that actually affect your credit score. Now, with the whole premise of making sure that things are kept simple, I'm not going to bore you with a bunch of mumbo jumbo. I'm going to keep this real simple, make sure that anybody can understand what I'm talking about. Now, you might want to ask yourself, what qualifies me to talk about this stuff? Who the hell are you to say everybody else is wrong? Well, real brief, if I can just qualify myself, again, Brian Otieno, Pentic Consulting Group, look it up online, give us a search on Google. We've been in business for too long, over 10 plus years. And as it pertains to the topic of credit, I have literally worked on so many credit reports and so many people's credit file that I can't even count. I've worked on judges' credit report. I've had attorneys that have had me work on their credit. So I'm definitely more than qualified to talk about this particular topic and to educate you on this particular topic. So let's get straight to it. Now, first off, it's really important to kind of understand the history behind credit. And I covered this in the book, so I hope you don't mind me kind of just going over some of my notes here as I kind of just look back on this. It's important to understand the history. Where did credit come from? The date is roughly about 1899, if my memory serves me right. And this was back in Atlanta, Georgia. A guy named Guy Wofford, who founded a retail company which eventually became Equifax. His main objective was to gather information about consumers and credit behavior, which banks and credit companies, lenders use to make their decisions. So what does that mean? This guy went around and he was like, you know what? I'm going to go to a bunch of these vendors that offer credit, and I'm going to gather information about how well their consumers pay back these credits that they're giving to consumers. And he gathered so much data, and whenever we came to, in my opinion, banks saw the value of this data. And it became time that whenever they would start introducing different type of products out there as it pertains to credit cards, personal loans, they needed something to evaluate risk. Let's just be honest. What is credit about? Credit is a tool that lenders use to evaluate risk. They can't treat everybody the same. So it's just a tool that they use to evaluate risk. So long story short, he went out there, he's gathering all this information, and after he gathers information, lenders found it very useful as far as a way to evaluate risk. Now, the problem came into when the information that they were gathering, it was almost impossible for lenders to base decision off these credit reports. There was just so much data. If you just think about it, lenders these days accept hundreds and hundreds of thousands of applications every single day. So for them to sit there and look at 30 pages of credit reports just for them to make a decision if a particular borrower was a good borrower or not a good borrower, it's just almost impossible. And in addition to that, back in the day, there was, the thing about, racism, sexism, and people are going to do what they're going to do. People, if somebody's racist, they're going to be racist. It doesn't matter what law you put out there, they're going to be racist. If somebody's sexist, they're sexist. So anyway, the reason I premise that is there's a difference between credit bureaus and FICO scores. FICO scores uses the data being held by credit bureaus, but this is a whole different thing. Why was FICO introduced? FICO was introduced in order to better simplify the process of evaluating risk. So now instead of the lenders having to look at all these pages of people's credit reports, they simply have an underwriting guideline, and they can say, okay, we only accept people that have a 650 FICO score, a 680 FICO score, whatever it is. What they did was it streamlined the process of lending, and it also eliminated this racism and basically remove the decision making from one individual into a particular system that can be followed and duplicated regardless of who's making the decision. Now, of course, it's not a perfect system. That's not what we're here today. What we're here today is talking about the 5 factors, the 5 things that truly affect your credit. But I wanted to give you that brief history so you kind of understand where this stuff comes from. You have the credit bureaus that started back in the day. The first one was Equifax. Later on, I believe Experian, which is, I believe, in Canada. And then there's TransUnion and so forth and so on. That's not really what's important. That's not really why you're here. That's for another video. What you're here for is to understand the 5 things that affect your credit. So let's get straight to it. And looking at the chart, again, I'm going to have a chart somewhere here or there. There's 5 things that affect your credit. As I explain this to you, I'm going to have a different way. Talk about the concept here is to keep things simple. So I'm going to explain to you what they are, but most importantly, I'm going to tell you how they positively affect your credit and how they negatively affect your credit. So let's get straight to it. So the first factor is payment history. Payment history affects 35% of your credit score. Now, again, over here we're going to talk about how to simplify it and how to make this make sense as it pertains to your life. Because if I just tell you that, what are you going to do with that information? So what is payment history? Payment history, again, it tracks, it's a way that creditors monitor if you make your payments consistently on time. So how does this positively affect your credit? Where if you make your payments on time, you will benefit from that 35% of what FICO evaluates. Okay, because there's 5 parts of your credit which make up 100%. So we're going to go over each one of them and how much effect they have on your credit. Payment history affects 35% of your credit. So by making your payments on time, you will benefit from this 35% of what FICO evaluates. Now, how does this negatively affect your credit? Real simple. If you don't make your payments, you'll have what you call, late payments. Late payments turn into collections. Collections, turn into charge-offs. Charge-offs turn into collections. Collections, judgments, bankruptcy, taxing, so on and so on. You kind of see the trickle-down effect. So payment history is really important. Again, 35% is a big piece of the pie. 35% of your score is based on payment history. Now, one thing that I have not seen being talked out there is in order for you to benefit from this 35% that FICO evaluates, you actually have to have something that you're paying on time that is on your credit report. One myth that I get all the time is people talk about, well, I make my rent on time. Well, your rent is not being reported on your credit report. Okay, I pay my electric bill on time, I pay my cell phone bill on time. These things are not being reported on your credit report. Now, there is a way that they can be, and that's on a later video, but commonly these things are not being reported on your credit report. So you don't need to rely on these things to be reported on your credit report. Another thing is, I'm in the lending industry, so sometimes I deal with farmers. Farmers are the type of people that pay everything in cash. I have a farmer one time, they'd be like, hey, I need to borrow $150,000, and I'd ask him, how's your credit? And they would say something like, well, my credit should be great, I pay everything in cash. Well, if you pay everything in cash, you do not have a payment history that can be tracked. So you have to have something that is reporting on your credit, that is reporting on your file that you're making consistent payments every single month. So again, 35% of your credit is what? Payment history. How does it affect you negatively? If you don't make your payments on time, the trickle-down effect, late, collections, charge-offs, bankruptcies, tax liens, and so forth and so on. So how do you benefit from the 35% of your payment history? You must be making payments on time. But you have to have accounts on your credit report that you're making payments on. So that's just kind of the trick there. Anyway, let me Switch that up. There we go. So let's move into the second factor. The second factor that affects your credit is, you might hear the word utilization. You might hear the word amounts owed. Now this is the one thing that nobody talks about this. I've seen a bunch of YouTube videos, but 30%, this amount owed, the utilization, it's only based on revolving accounts and revolving accounts alone. What am I talking about here? I'm talking about credit cards and credit cards alone. What am I trying to say here? I want you to this message to really hit home. If you don't have credit cards, you cannot have a good credit score, period. Stop listening to Dave Ramsey and all these people that are telling you, cut all your credits, you don't need this. It's just BS, okay? I didn't make the rules, okay? This is just based on what FICO evaluates. 30% of your credit score is based on how much access you have to credit, your utilization or amounts owed. All of these things mean the same thing. To make it make sense, it's balances relation to limits on all your open revolving accounts. I'm going to repeat that. Balances in relation to limits on all your open revolving accounts. Let me give you an example. If you have a Capital One card or American Express card or a Chase card with a $1,000 limit and a $500 balance, that means you're 50% utilized. Let me give you another example. If it has a $1,000 limit and a $300 balance, that means you're 30% utilized. So what I've noticed, and we're going to make another video as to Brian's rules as it pertains to credit, but the higher your balance is closer to the limit, the more effect it has on your credit as far as a negative effect. So you want to keep your balances low in order for you to benefit from this 30% what FICO evaluates. Now again, I just told you right there, like, we're going to talk about how these things affect you negatively and positively. So how does this affect you positively? Number one, you must understand this. In order for you to benefit positively from utilization or 30% of your credit, which is amounts owed or whatever you want to call it, you must have revolving accounts. You must have revolving accounts. Okay? So that's number one. Number two, how does it affect you positively? The lower your balances are in relation to the limits, the better you benefit from this 30% of what FICO evaluates. Where should your balances be? Stay tuned. I got another video about that. Now, how does this affect you negatively? Real simple. If you're close to the limit or pretty much on the limit, you got that $1,000 credit card with a $1,000 balance, you're basically 100% utilized, or $1,000 credit card limit with a $900 balance, that means you're 90% utilized, then it starts taking a negative impact on your credit score. So you want to make sure you keep things low in relation to the limit. How much low? Again, stay tuned. I got more videos coming on this topic. Now we're just introducing these 5 factors. So moving on, hopefully you got that. The next big chunk on your credit is, and actually I'm going to make a video, matter of fact, and I'm going to tell you why do these credit bureaus care so much about these goddamn credit cards. Because if you just really think about it, 30% of your credit is based on credit cards and credit cards alone. That's huge. That's huge. And let me even swing it up a little bit. You can make 65% of your credit can be based on credit cards and credit cards alone. If you see the 35% payment history plus the 30% utilization, that's literally 65% of your credit can be affected by credit cards and credit cards alone. We're going to talk about that later on. Let's keep this going and stay on topic. A big part of it, 15% of your credit is based on length of credit history. What am I talking about here? I'm not talking about your age. I'm not talking about your date of birth or how old you are. It's your length of credit history. How long of a credit profile you have based on the oldest account reporting on your credit profile. The much longer your credit history is, the better you benefit from this 15% of what FICO evaluates. So again, that's just pretty self-explanatory. How does this positively affect your credit? Well, you have to keep accounts open for a long period of time. How does this negatively, so for you to have a long credit history, how does this negatively impact your credit? Well, if you have a very short credit history, meaning that you don't have long, consistent history with, and this pertains to the opening date of the trade lines on your credit report. Okay? This is not your birthday or how old you are. It doesn't matter if you're 99 years old and you just started building your credit 2 years ago. You have a 2-year payment history. Okay? So that's why it's really important, especially for parents, to start helping their kids developing credit at a very young age, because if 15% of their file is based on credit history and credit history at all. So it affects you positively by having a long credit history, it affects you negatively by having a very limited short credit history. Let's move on. 10% of your credit is based on what we call credit mix or diversification. This is where you benefit from having a mortgage loan, a student loan, an auto loan, and all these other things that we're talking about. only affect 10% of your credit as far as the diversification. Now, real simple. How does this affect you negatively? It affects you negatively if you're not diversified. If all you have is like an auto loan, or all you have is like an auto loan, a student loan. This, in my opinion, should happen naturally. As you progress through life, you're going to need a car loan. You're going to get a mortgage. You must have credit cards because, again, 30% of your credit is based on your credit cards and your credit cards alone. So your credit mix kind of tends to happen naturally. There's nothing really you can do to work on that other than just making sure that you are diversified. Actually, there is a lot you can do. You can make sure that you have a credit card. And there's different types of credit cards. Man, we're going to talk about that in another video. I got so much I want to talk about. So anyway, moving on. We talked about 35% payment history. We talked about 30% utilization or amounts owed. We've just talked about 15%, which is length of credit history, and then 10%, which is diversification or credit mix. Now, lastly, we're going to talk about 10% of your credit, which is affected by what they call new credit. So what is this? As you start establishing credit, you can see a positive effect on your credit by about 10% as you're adding on new accounts and so forth and so on. Now, how does this affect you negatively? There is such a thing. I always say this, it's an old joke. You probably, if you heard me talk, you've heard me say this before. I always say that banks only lend money to people who don't look like they need money. And this is where you hear that, a lot of people, when they talk about, I don't want to have a lot of inquiries, I don't want to lower my score. This is where it comes from. If you have a lot of inquiries on your credit, you look desperate, okay? And again, banks only lend money to people who don't look like they need money. Now, how many inquiries should you have? Stick around. I got another video. I call it Brian's Rules on how to manage each one of these factors. And matter of fact, catch my book. I got this book. Go to 3pathsoflending.com. I talk about, there's a section on here, a bonus chapter that I talk about credit. That's kind of where I'm getting my notes from. But there's a bonus chapter here that I talk about credit. Most importantly, this book is about funding. And kind of, there's a lot of myths about funding. Man, we're going to cover a lot on this YouTube topic. But get my book, 3pathsoflending.com. It's a great book. You can get it on my website. It's also on Amazon. You might want to get it on my website. It's much cheaper than it is on Amazon. But I cover all these concepts. And I also talk about the Brian's Rules. There's a chapter on here that talk about Brian's Rules and how to manage your credit. I am going to make a video about it, but of course, there is a chapter on here that you can read, and it kind of covers everything that I'm talking about. Lastly, what is it? So I think we've covered it all. 35% payment history, 30% utilization, 15% credit length of credit history, 10% diversification or credit mix, and 10% new credit. And going back to how does this affect you negatively? Payment history, you gotta make your payments on time. That affects you, if you don't make your payments on time, it will affect you negatively. Amounts owed, you must make sure you maintain a low balance, but you have to have credit cards. 15% length credit history, you must make sure you have a consistent long credit history. Credit mix, you must make sure you're diversified. And new credit, always remember this, banks only lend money to people who don't look like they need money. So anyway, I appreciate you for joining me in this video. I hope you guys like this type of content. This is my first video that I'm going to be doing in this similar format. And I also, like I said, I got this book that you probably want to grab. I talk about the 3 paths of lending, the 3 ways that you can get money for your business. I don't care who's lied to you out there. There's only 3 ways you can get money for your business. We're going to talk about that in another video, the 3 paths of lending. And also, I do have an incubator program, one of the first entrepreneur incubators out there. And what we do is, just like an incubator at the hospital, what they do is they take a baby that is premature, they put them in the right environment to make sure that they're nurtured, they have the food and whatever they need. And what I noticed in my years of being in the lending industry, it's almost like rocket science out here to start a business. You gotta incorporate, you gotta get your EIN number, you gotta get a website, you gotta get a logo, you gotta get a client management system, you gotta worry about accounting, you gotta worry about marketing. There's just so many different pieces of how to start a business that, that's why most businesses fail. 50% of businesses fail usually within the first couple of years. That's just ridiculous. And they, in my opinion, they just need guidance. If they had a little bit of guidance, a little bit of assistance, and that's what we've done. We've created an entrepreneur incubator program. I'm going to put a link in the description. There's a training that I've made, and you probably want to watch if you're planning on starting your own business, or if you're one of those 85% of Americans that hate their job. I mean, damn, did you just hear what I just said? 85% of Americans hate their job. But one thing I love about this country, because I'm an entrepreneur myself, I'm originally from Kenya, and people have a very entrepreneurial-minded spirit. You know, people work harder than any other country in the world, in my opinion, in this country. So people, especially these 85% of people, a lot of them have great ideas, but they just really don't know how to branch out and start their own business. So I've started the first entrepreneur incubator program, and what I do is focus on helping entrepreneurs, and just like the incubator at the hospital, we provide the right environment. We'll help you with every aspect of your business, as far as from beginning to end, incorporating, getting your EIN number, getting your bank account, getting your merchant account, getting your website, getting your client management system, putting you in the right mindset. All of these things that entrepreneurs need in order for them to be successful. So anyway, I really appreciate you. This is one of my many videos I'm going to be making. I'm kind of changing the topic on my YouTube channel here. There's, I was talking about my son and family before, but now we're going to be talking about finance and what I really do and what I'm really truly passionate about. I'll see you in the next video. I really appreciate it. Thank you so much.